Joining me now is Jay Van Sciver. He's sector head of industrials at Hedgeeye Risk Management. Thanks for joining us today, Jay.
Great. Thank you so much for having us, Mark.
Now, you wrote a report on gold and gold stocks a while ago. It was very thorough. And one of the things that you mentioned was that large cap names, the likes of Newmont and Barrick, are good defensive longs in this kind of environment that Hedgeye deems quad four, i.e., decelerating economic growth, decelerating inflation. Could you flesh that out for us a little bit?
Sure. So, one of the questions you always think about is like, if I'm in a dark room and I have to make stock choices and I don't really have, a whole bunch of other information, what are like a few data points I could use to actually generate alpha, right? So one framework from a macro standpoint that we use is what we call the quads, right? So quad one is growth and inflation are accelerating. Quad four, which is where we are currently in the second quarter, is growth and inflation are decelerating, right? So you're getting a disinflationary environment with slowing growth. And I cover industrials and materials. So for slowing growth for industrials and materials can be incredibly relevant because so many fleets add units based on economic growth. So if you have a GDP tied fleet with 100 units, right? You'll sell 2 units if you have 2% GDP growth, and then you have replacement demand on top of that. So you could actually see units, if growth went from 2% growth to 1% growth, unit sales could actually go down, even though you didn't enter a contraction in GDP, because so many of these fleets and end markets are tied to growth and rate of change in growth as opposed to just, level of activity. So within the context of gold stocks, defense stocks, things like that tend to perform better in quad four in these slowing growth environments than things that are more pro-cyclical, like small manufacturers.
Having said that, Jay, you've also noted a divergence between the price of gold, which, for argument's sake, as we sit here, is around $2,000 an ounce US, and yet gold stocks have not really kept up. They've lagged. So what's a rough estimate in terms of how the Newmonts and Barricks can catch up, or even the intermediates and the juniors? Do you have any rough numbers?
Well, yeah, I think one of the things that happens is you have a divergence in sort of the sentiment and expectations for these gold producers, the effects of their own cost structures and in an inflationary environment. And that when you get into, sort of a more growthy narrative, AI, whatever, we use Tesla typically as the poster child for stocks like that. When they tend to do well, you'll see, money and allocations move out of the more defensive areas, and the divergence between, say, the commodity price and the underlying share price of the equity. You can quantify that differently for different names, and it's a little tricky because Newmont's involved in a large transaction. A Barrick or a Newmont are at very different places on the cost curve and would have different correlations to the gold price. But in general, in equities, when you're looking for edge or alpha, a divergence in a series that's typically highly correlated is, first off, interesting, right? And oftentimes an indicator of potential alpha.
Now, there are a number of factors that can drive the price of gold, as you know, but would you say that maybe the one constant is real interest rates? And if so, could you flesh out that dynamic?
Yeah, one thing that's interesting about the gold equities is I think people assume that they are going to be, basically as an inflation hedge, that they'll actually outperform when inflation is high and underperform when inflation is low. And interestingly, with Newmont and a couple of the other ones, we actually see a negative correlation to CPI for the equities relative performance. And that's in part because of the defensive character of the group, right? They are, typically lower beta, comparatively less cyclically exposed than the typical mining and metals companies, like a steel producer. So what right now an interesting pair we have on is to be long gold, short the mini mills, Steel Dynamics, Newmonts, and whatnot on the short side, right? So you get that spread. But yeah, negative real rates, interest rate moves do tend to correlate quite well. And if you're, again, in that dark room trying to make a forecast of commodity prices in general, real rates are an important forecasting tool. For some, like for example, crop rates is basically one of the best drivers. If you can tell me where real rates are going to be in a year, you can say something reasonable about where corn prices or wheat prices will be in a year. And gold falls into that category as well, with a slightly different dynamic at play.
You touched on inflation there. Let's carry that further. Anybody who's followed gold over the years, we always hear gold is a good inflation hedge. We hear that from portfolio managers and others. But historically, you say that that's actually not correct. Am I hearing you right there?
Well, so I think to some extent you have a difference between the equity price of, say, a Newmont, which is, you can just run a regression, can structure the regression however you want, and you're going to get a negative relationship to CPI and not a positive one. And that is, a little tricky. Things that are very positively correlated as equities to inflation would be the fertilizers. Look at CF or Mosaic or Nutrien, right? Those are strongly correlated to CPI, whereas gold and the precious metals are not as, the producers of them are not as straightforwardly correlated to inflation, right? You have a slightly negative number, correlation coefficient for Newmont's relative performance, and that's in part because it is more of a currency, it is more defensive. If there were a large scale war that broke out in Europe, gold prices would soar. Real rates would most likely go negative. People would seek out safety in things like treasuries and precious metals. And one of the things that's interesting, well, there's a lot of things, but in general, we are in, I think, a less geopolitically stable environment than we used to be, and I think that's a driver of investment in gold. And gold is also something with industrial end markets and consumer end markets that can add to that counter-cyclicality and pro-cyclicality in their own ways. You see more scrap available in difficult economic times, certainly in the 08-09 period. So that there are independent drivers in each metal or commodity that we cover. But gold, I think, on balance, is less pro-cyclical, less of an inflation hedge as a result, relative to nitrogen fertilizer.
Last year, central banks bought more gold than they ever have in a single year. Is that because of some of the reasons you're discussing there, geopolitical risk, financial stresses, and beyond that, what's the significance? What's it telling us that central banks are piling up so much gold?
Well, I think it's a great question, and it's always hard to get into the minds of the global central bankers and know exactly why they do what they do. But I think you see a change in behavior in the right before and after the financial crisis. I think that's an important inflection point. In the 90s, they were sellers, and it was a dumb rock you buried in the backyard, and everyone wanted fiat currency. And then as you get into issues of sovereign credit and central bank credibility, you see more of a willingness to accumulate gold at central banks, to become net buyers, and have been net buyers ever since. I think that is, we can look at measures of geopolitical stress, right? So there are indices that track that, and those indices of geopolitical stress tend to correlate very well with central bank purchases, as well as the gold price in general, and investor interest in gold. So I think it's telling you that central bank credibility is important, that central banks are probably more concerned about that, and their QE around the world, those policies are in place, right? So that's, I think, something that's dicier from a credibility standpoint. And you see more geopolitical risk than you had in, say, the 1990s, when it wasn't as interesting. We were in a unipolar world, if you will, with the U.S. is really the only superpower, no great power struggles, things along those lines. It was just a different dynamic. So we do see central bank purchases since the financial crisis, And I think that's just a different credibility and geopolitical risk environment in which we now live.
At the opposite end of the spectrum, you've got retail investors who don't seem to be very involved with gold and gold stocks in a general sense right now. Would you say that historically, when they do get involved in a big way, is when they start seeing headlines, they get some FOMO, and they start chasing the price? Is that a fair assessment?
I think that was certainly the case towards the end of the last decade, right? In the in general, you want to buy assets and investments that are out of favor. Sometimes they're out of favor for a reason, so you always need to be a little careful with how you select that kind of thing and do your due diligence. I mean, I think gold has been a currency for a really long time and a valuable asset for an exceptionally long time. It has real uses, real markets that I think underpin value. So I don't think it's a super risky out of favor investment or anything like that. It's just it is less desirable, I think, coming out of periods of time when people are excited about growth stocks, for example, or investors are into, for a little while they were into SPACs. Now it's whatever the flavor in AI is this month, or Nvidia, or investors move around. They're fickle, particularly on the retail side. If you look like AMC or whatever, but I think you do see less growth in investor purchases of gold, which is an important source of demand for the metal beyond jewelry and central banks. And in general, I think you're probably going to want to avoid buying it when it is, very much in favor with those, individual purchasers of gold.
And that leads me to a nice visual that you presented in your gold report a while ago, which is you're essentially saying that investors should have their gold in a bunker right now. And then when they start seeing people piling into that bunker, that's when they should be getting out, selling off the gold to those people getting in, and using it as a source of funds.
Yeah. So just in general, I think we're positioned a little more defensively as a from a macro standpoint as a firm, and within my coverage as well. We're more, it's sort of, I wouldn't say max defensiveness, but very close to max defensiveness. And you need to become defensive. If you're going to panic early would be the other way to say it, or never get in a crowded bunker would be the other way to think of it. Like, you don't want to be panicking, in March of 2009. You want to be the person who's concerned about economic growth in mid 2008. And that doesn't mean that we're in 2008, 2009. It's just conceptually within the framework of you wanting to buy assets that are undervalued and sell assets that are more richly valued, the way you should be thinking of it. So, I think buying something like gold, which is currently, well, we did a deck yesterday on defense stocks, right? So looking at the recapitalization of the U.S. defense assets, long-lived assets like ships, the recapitalization of NATO, increased geopolitical tensions, the same dynamic that we see in gold, right? These are areas that are very much out of favor at the moment. Most defense stocks are off 30% year to date. That's interesting, right? We're in a longer term upcycle. We're in a longer term cycle of increasing geopolitical tensions. I mean, you had drones dropping bombs on Moscow. That's kind of a big deal. Like, that doesn't happen very often historically. We have, large land war in Europe. We have China's refusing to meet with U.S. leaders. They sent that balloon over the U.S. That was weird. There's a lot of things that are riskier in a more existential way and in a way that requires more preparation than we've seen, in say 2005 or 1995. One of my colleagues is Neil Howe, who runs our demography group, and he wrote a book called The Fourth Turning. And the update is coming out in July. It's an excellent read. I have the preprint copy sitting next to me. And it's absolutely a page turner for all those reasons. He points out that, in the 1930s, you had a whole bunch of letter agencies, the Tennessee Valley Authority, TVA, all the Roosevelt programs, FDR programs, and then you go through the decade of the financial crisis. You have TARP through most recently PPP, right? That's quite a similarity. You again have a dictator in Russia who's saving the world from fascism, right? There are a lot of echoes that you can see in this period to periods of time. And of course, you don't have a fair gold price for the last fourth turning. But I'm pretty sure if you had a fair gold price, it would be an extremely bullish environment from the lows of the Depression through the peak of World War II. So I think you're in a similar dynamic now. I think fourth turning is a compelling framework to understand social evolution over a longer cycle, a longer period of time, and is well worth considering. We have a page or two on that in the deck. It's not the driver of the thesis at all. Availability of new gold resources, development activity, things like that, I think are much more basically bullish for gold discoveries. But I think, at the end of the day, you need a buyer. You need people to be worried about growth, about security, about credibility. And gold is something that ultimately instills a lot of credibility on asset. It's one of the most credible assets throughout history. So I think those are important dynamics to consider as well.
I'm looking forward to reading the fourth turning. I know the guys and gals at Hedgeye have been talking about that and how Neil Howe does discuss those essentially 80-year cycles that you were referring to. So lastly, Jay, here at Red Cloud, I've had the opportunity lately to talk to some, what we consider here in Canada, some legendary gold miners, the likes of Ross Beatty, Rob McEwen. And I've been asking them, is this the best or one of the best setups you've ever seen for gold? So I know you've covered it for a long time. I believe you own some as well. So what's your opinion? Is this at least one of the best setups you've ever seen?
I think for gold equities, which is sort of my purview, I think it is a very straightforward overweight, right? And it's very rare that we get things that seem relatively straightforward. We're always careful to say, to caveat that in all the ways that you typically would. But I do think it is a good setup for gold. Is it ever perfect? Is it ever clean? No, but as we were talking about, like, you haven't had a lot of gold discoveries, and the thing that's interesting about discoveries is you needed discoveries 5-10 years ago to drive new supply today. So we have really good visibility into supply growth because it takes a long time to develop a mine, right? It's like a torpedo in the water. We have really good reasons to expect demand growth to remain stable to potentially quite robust if we end up in a less desirable geopolitical environment. And then from the equity competing things I can own, right? So you're always overweight, underweight relative, or long or short relative. The other things that I can own, when I look at most cyclical backlogs of orders, right? We're in a deteriorating order environment. Everything is later cycle this time because of the supply chain difficulties, right? So some backlogs are really extended and dribbling out slowly because of supply chain difficulties, inability to produce as many, for example, cars as you want. So a VW is sold out into the third quarter in Europe, right? So, but as you start to get past these backlogs, you're going to see cyclical stocks. I think mining stocks were, again, bearish on steel, fertilizer, all these kinds of things. As they run through their backlogs, it's going to be very easy, I think, to see gold equities perform better on a relative basis to those more cyclical components, which are going to have most likely oversupply relative to incoming demand and orders.
Such great insight and information today, Jay. Thanks so much for your time. Keep up the great work at Hedgeye.
Great. Thanks so much for having me.
Jay Van Sciver, he's the sector head of industrials at Hedgeye Risk Management.